Welcome back. So, let us continue with the example about the pricing or the valuation of a forward contract at a date subsequent to the date of its inception. We consider a contract, let us call it contract A, that is instituted on January 1, and that entails the delivery of $1 at a price of 75 on 31st of December, which is the date of maturity of this contract A. So, $1 is to be delivered under this contract against a payment of INR 75. Let us say we are to value this contract as on April 1 of the same year, and let us say at that point in time the forward price of the US dollars has gone up from 75 to 90 for delivery at the as on 31st December. In other words, if we enter into a forward contract, let us call it contract B. If we enter into a forward contract as on 1st April of the year for delivery as on 31st December of the same year, that would entail a price of INR 90 for $1 of the being the underlying. Now, what we have to do is we have to value the contract A as on April 1 of that year. So, what we do is as I mentioned before the break, we construct a portfolio comprising of a long position in A and a short position in B. The value of this portfolio will be V A minus V B, and because V B is equal to 0, the value of a contract on the date of its institution is always 0. So, this is equal to V A. And now, let us look at the payoffs from the contract. The payoff from the contract, because we have a long position in A, that would mean what? That means we will receive the dollar by paying INR 75. The short position in B means what? We will deliver the dollar at INR 90. In other words, the dollar content cancels out as far as the portfolio is concerned, and we end up with a net surplus of INR 15. So, the payoff from the contract as on 31st December is INR 15. Assuming that both the contracts are default free, we discount this value at the risk free rate to bring it back to April 1, and that will be the value of our contract here. So, this will be equal to 15 e to the power minus r into whatever the time period is. In our case, it is 9 months. So, that will be 3 by 4th of a year. So, this is an example of how the value of a forward contract subsequent to its date of inception may be calculated, and clearly it may or may not be 0, that is the important thing. So, it depends on the price or the forward price that is prevailing on the date of valuation of the contract. Let us do a formal example on this. On 1st January 2018, the spot price of wheat was rupees 1200 per quintal. X took a long position in a forward contract with maturity of 9 months. The risk free rate of interest is 24% per annum with continuous compounding. However, on April 1, 2018, that is 3 months after the institution of the contract, the spot price of wheat of the same quality had increased to rupees 1400 per quintal. At t equal to 0, it was 1200. At t equal to 3 months, that is 1st April, it was 1400 per quintal, while the risk free rate remains unchanged. Calculate the value of the original January 1 contract. Let us call it contract A. So, calculate the value of contract A as on 1st April of the year, that is 2018. This is quite simple. We work out the future value of this contract A as on a date of valuation, that turns out to be 1274.2035, and we determine the value of the contract, and that is 125.79614. Another example, on 1st April 2018, a stock was expected to pay a dividend of 2.10 per share in 2 months, and in 5 months same amount 2.10 at t equal to 2 months and 2.10 at t equal to 5 months. The stock price on this date, that is t equal to 0, was 50, and the risk free rate of interest was 24% per annum continuously compounded. An investor has taken a short position in a 6-month forward contract on the stock on that date. 3 months later, 1st January 2018, the price of the stock was 44 and the risk free rate was still 24% per annum continuously compounded. Calculate the value of the contract. Now, there is an important catch here. The important catch is here is that the contract is instituted on 1st April 2018, and that means let us take that as t equal to 0. The dividend payments are at t equal to 2 months and t equal to 5 months. So, that works out to 1st of June and 1st of October. Now, the maturity of the contract is 6 months. And maturity of the contract is given as 6 months. So, the important thing here is the dividend at t equal to 2, there are two dividend points, t equal to 2 months, t equal to 5 months, that is 1st June and 1st October, and the maturity of the contract is 6 months from 1st April. So, that is as on 30th of September or 1st of October. Now, that means and we have to value the contract as on 1st July. When we value the contract at 1st of July, one of the dividend payments would have expired. In other words, the valuation of the contract as on 1st July will be on the basis that the remaining life of the contract involves only one payment of dividend, not two payments of dividend, because one payment of dividend would already have taken place between 1st April and 1st July, that is on 1st of June. So, that is the catch here in this problem. Let us solve this problem. So, this is the time frame, this is the current spot price, and this is the risk free rate, right, and these are the present values of the two dividend payments, t equal to 2 months and t equal to 5 months. The total dividend payment is this much. So, the net stock price at t equal to 0 is this much, 46.08, and the forward price at 1st April is 51.9575. I repeat, this is the forward price as on 1st April of the year 2018 at the date of inception of the contract. Now, we look at the forward price as on 1st of July, that is the date of valuation of the contract. When we work out the price as on date of valuation of the contract, the important point here is that only one dividend stream will remain. The second dividend stream is 0. That is the important part, because that dividend the first dividend stream, that is the dividend stream at t equal to 2 months, would already have paid out before the date of valuation and will not contribute to the forward price when we work out the forward price as on the date of valuation. That is the catch here, that is shown here also, and hence the present value of dividend works out to 2.0177. The current spot price is 44. Therefore, the net price is this 41.9823, that is S0 minus D0, and the forward or the future value of this price at the date of maturity of the contract, that is 1st October, is 44.5784. So, the differential in prices is 51.9575 minus 44.5784, and the present value of this amount is equal to 6.9494, with the present value on which date? On the date of valuation, the present value on the date of valuation. And please note, this is positive. Why? Because the investor has a short position in this. So, notwithstanding the fact that there is a decline in price, he tends to gain because he has a short position in the contract. Okay, so that is all that is required or relevant in so far as forwards are concerned. Let us start with options. What is an option contract? An option is a contract whereby the holder of the contract acquires a right. This is the catch, this is the important part, right, prerogative, privilege to buy or sell a certain asset on a certain date at a certain price. So, the important thing is this word, right. So, if one of the parties has a right, it is quite natural that the other party has the obligation, because if A exercises the right, then B is under obligation to honor his leg of the contract. B does not have the right that if A is exercising, B will also exercise. That is not the point. The point is, if A exercises, then B must deliver, or B must honor his leg of the contract, and if A does not exercise, well, it is fine for B, he goes scot free. Now, the second important thing is, because they are not on equal equivalent pedestals, A has a right, B does not have a right. Therefore, A has to compensate B for with a certain amount of money, which is called the option price or the option premium, such that he acquires that right from B, and B, in compensation of the amount of a premium or a price, is willing to take up the obligation. That is how the option contract operates. So, an option is a contract whereby the holder of the contract acquires a right to buy or sell a certain asset by or on a certain date for a certain price. Accordingly, the writer of the option, the first party is said to be the holder of the option, the second party is said to be the writer of the option, the first party is said to be long in the option, the second party is said to be short in the option, the first party is said to have bought the option, the second party is said to have sold the option. Accordingly, the writer of the option has the obligation. So, this is the important word. Here we have a right, here we have an obligation to sell or buy the asset by or on the said date at the said price, if the holder decides to exercise the option. So, this is another catch, if the holder decides to exercise the option. The choice, the discretion, the privilege is with the holder of the option, whether he wants to exercise the option or he does not want to exercise the option. The party B, that is the party who has written the option, party who is short in the option, has no discretion. Quick reference to terminology. An option which has a single maturity date, that is which matures on a particular date. In other words, the option can be accessed only on a particular date, which is called the maturity date of the option, is said to be a European option. An option which can be accessed on any day up to the date of maturity is said to be American. So, I repeat, an option that can be accessed only on a particular date, which is called the maturity date of the option, is a European option. An option which can be accessed on any day up to the maturity of the option is said to be American. Underlying asset, the asset which forms the substratum of the option contract, that is the asset which can be bought or which can be sold at a certain price on a certain date or by a certain date for that matter, is said to be the underlying asset. It forms the substratum of the contract. It is the item entity that changes hands as a consequence of the option contract, if the option holder decides to exercise the option. Call and put options. Call option is the right to buy, put option is the right to sell. If you are long in the call option, you have a right to buy the underlying asset at a predetermined price on a predetermined date. Both predetermined price and predetermined date are part of the option contract and are determined at the inception of the option. It is not that you can buy the asset at the then prevailing price. That is not the case. You can buy the asset at the price that is agreed upon at the t equal to 0 date, which in fact is called the exercise price or the strike price under the option contract, on the date of maturity or by the date of maturity, which is called the maturity date of the option or the exercise date of the option. So, call option right to buy, put option right to sell, strike date the date on which you can exercise the option in the case of European options, the date up to which you can exercise the option in the case of American options. Holder of the option, the person who has the right, the writer of the option, the person who has the obligation. Long position, the party who has bought the option, short position, the party who has written the option. Moneyness of options, if at a particular point in time, let us consider for that matter, let us be concrete, let us consider a call option. Call option is the right to buy. Now, suppose on a particular date, ST, what is ST? Let me explain the notation for a minute. ST is the instantaneous stock price, instantaneous price per unit of the underlying. T is a given point in time, an arbitrary point in time, and the spot price or the price in the spot market of the underlying asset at that point in time T is represented by ST. K is the exercise price of the under the option contract, that is the price at which you can buy or sell, as the case may be in the case of call or put options under the option contract. So, if ST is greater than K, if any particular point in time, at any particular point in time small t, ST is greater than K, that is the prevailing stock price in the spot market is greater than the exercise price of the option. The option is said to be in the money if it is a call option, the option is said to be out of the money if it is a put option. If ST is less than K, that is the instantaneous stock price is less than K, then the option is said to be out of the money. If it is a call option, it is said to be in the money if it is a put option, and if ST is close to K or ST is equal to K, the options are said to be at the money. Value of an option. The value of an option can be split up into two parts. Number one is the intrinsic value of the option, and number two is the time value of the option. The intrinsic value of an option can be defined by equations number 1 and 2 for the call option and put option respectively. So, intrinsic value of a call option is the maximum of 0 comma ST minus K, that is if ST is less than K, the intrinsic value is 0. If ST is greater than K, the intrinsic value is ST minus K. Similarly, in the case of a put option, if ST is less than K, the intrinsic value is K minus ST. If ST is greater than K, the intrinsic value is 0. This is the case of a put option, and in the call option, equation number 1 holds. Now, the second part is the time value of the option. The market price of the option is usually greater than the intrinsic value, and the differential between the market value of the option, the market price of the option and its intrinsic value represents the time value of the option. The time value of the option arises from where? We will come back to it, but before that let us finish off with the notation. Small c represents European call option price, small p represents European put option price, S0 is the stock price at t equal to 0, K is the strike price, I mentioned that, T is capital T is the maturity of the option, sigma is the volatility of stock price, we shall be talking more about it. Capital C is the American call option price, capital P is the American put option price, S T is the stock price at maturity, capital T. D0 is the present value of dividend paid during the life of the option. We have encountered that in the context of forwards. R is the risk free rate of interest with continuous compounding, and maturity equal to capital T. Now, profit diagrams of long call. Before that, let me go back a bit and explain the relevance of time value of an option. You see, very often it happens. It is true that the option on an underlying asset derives its value because of the uncertainty in so far its exercisability is concerned. There is always, for example, let us take the case of a call option. Let us say at a particular point in time, let us say as on a particular day, say 1st of April, and the stock price is 50 and the exercise price is say 60. So, obviously, the option is out of the money. Even if you exercise the option, you will not get any profit because the market price is lower than the exercise price. So, what is the point in buying at 60 if the market price is at 50? Suppose the maturity of this option is on 1st of May, that is in 1 month from today is 1st of April. Now, there is always a possibility that notwithstanding the fact that as of today the intrinsic value of the option is 0 because the market price is lower than the exercise price, there is always a possibility that as on the date of maturity, that is as on 1st of May, the market price of the stock could go above the exercise price, and therefore, the option which is not profitable as of today may become profitable at a future date. Now, if that possibility, that eventuality has a certain finite probability, and it is the discounting of that probability in some sense that gives rise to the time value of the option. See, if you work out the intrinsic value of this option at this point, it is clearly 0 because the option is not worth exercising. But however, because the option has the possibility of earning you a profit as on the date of maturity, if the stock price goes above the exercise price of 60, that possibility when translated to money terms will give you a certain add on value to the price of the option or to the value of the option, and as a result of which the current market price of this option would be greater than 0, and this excess is basically the time value of the option, right. So, let us now talk about the profit diagram of a long call. I just mentioned that if ST is greater than K, then the option would be in the money, and if ST is less than K, the option would be out of the money. Let us understand the rationale for this. What is the call option? The call option is the right to buy the underlying asset. We are talking about European options. So, ST is, let us assume that ST is less than K. What does it mean? It means that the market price is lower, the exercise price is higher. So, why should I invoke the option and buy at the higher price? If I want to acquire the asset, I would rather buy it in the market at ST and let the option lapse. So, the bottom line is that if ST is less than K, the option will not be exercised. If it is a call option, of course, but if ST is greater than K, then what happens? Suppose the market price is 70, market price has gone up to from 50 up to 70 and the exercise price is as 60. What will I do? As a rational investor, I will exercise the option, buy the asset at 60 and immediately sell it in the market at 70 and pocket a profit of 10 units of money. So, that is what would happen if ST is greater than K. In this case, the option will be exercised. And what is the net payoff? ST minus K. And what is the net profit? ST minus K minus the option price that we pay to acquire the option. So, the payoff is ST minus K, the profit is ST minus K minus C, and the important thing is please note there is a time differential involved between the payment of the price and the payoff from the option, but because the option price is very small, this time value on this time differential is usually ignored when we prepare the payoff diagrams, and we write the payoff as ST, we write the profit as ST minus K minus C instead of ST minus K minus C e to the power RT, because we should be taking the future value of C, because C is paid at t equal to 0 or at an earlier date when we acquire the option, and obviously on the date of maturity we should be considering the future value of the premium that we pay, but normally that is very small, that is insignificant, and therefore we ignore that, and therefore the profit is ST minus K minus C and the payoff is ST minus K if ST is greater than K, and if ST is less than K, the option will not be exercised, the payoff will be 0 and the profit will be equal to minus C, because the amount of premium that you have paid is a loss for you, it is a sunk cost, and therefore it will be considered as minus C, and that is the rationale of this profit function. Pi of long call is equal to minus C if ST is less than K, and ST minus K minus C if ST is greater than K. And what is the and this is the plot, this is the payoff diagram, and this is the profit diagram rather, as you can see here. And what are the break even points? You can see here, this is the break even point. What is the break even point? The break even point is the point at which a situation of no profit, no loss emerges from the strategy, and this is given by K plus C, as you can see here in this diagram. It can be calculated geometrically, it can be calculated from the profit function as well, by equating this to 0. If you equate the profit to 0, you get ST is equal to K plus C as the break even point. And some other features, the profit under the strategy of a long call is unlimited, whereas the loss is restricted to the amount of premium that we have paid for acquiring the option. As far as the short call is concerned, it is the inverse, it is the mirror image of the long call, and you can see, you can make that out from this profit diagram, and you can also make it out from the profit function here. The maximum profit that you have is the premium that you receive, because obviously you cannot go beyond that. There will be no situation in which you will get a profit above the premium. The maximum loss is unlimited, corresponding to the maximum profit of the party who is long in the option, and the break even point is again K plus C. What is the investor perception, by the way? What is the investor perception if you are having a long call strategy? That is very interesting, that needs to be explored. Clearly, you see from this diagram that higher the price of the underlying asset at maturity of the option, higher is your profit. It's clear from this function as well, ST minus K, higher the value of ST, because K is constant, K is the exercise price that is contained in the offer document, that is fixed once and for all. And C is also the price that you paid. So, C also does not go into the picture, that has already been paid. So, the only variable as on the date of maturity is ST, and you find there from the profit function as well as from the diagram that higher the value of ST, beyond K, higher is the profit. Up to k the profit is fixed, or the option will not be exercised, and therefore, it is a loss of the premium. But once the stock price ends up at maturity of the option at any value above k, you tend to gain by doing what? By buying the asset at k and selling it in the market at st. So, the net result is that why would or when would an investor enter into this strategy? An investor would enter into this strategy when he feels that the market is likely to be extremely bullish, the underlying asset is going to be sold or is likely to result in a significant price rise, as on the date of maturity is extremely bullish about the prospects of the underlying asset as on the date of maturity of the option. The inverse is the case here. What will happen if the stock price goes below the exercise price, or if the stock price remains below the exercise price as on the date of maturity of the option? The option holder will not exercise the option, and if the option holder does not exercise the option, the option writer the option writer will pocket the premium arising out of the sale of the option to the long option or the option holder. Relation between premium and strike price for calls and puts. This is very interesting. You see, what does the call option give you? The call option gives you a right to buy the asset at k irrespective of what st is. So, clearly higher is the value of k. That means you have to shell out a higher amount for buying 1 unit of the underlying asset. Therefore, lower would be the premium. Higher the value of k, higher is the exercise price, the higher is the price that you are going to pay for acquiring the asset under the option contract, and therefore, lower would be the premium on that. In other words, if you have two options A and B, two calls A and B, A entails on the same underlying, A entails buying the asset at 50, B entails buying the asset at 100. Clearly, the cost of A would be higher than the cost of B, the cost of B would be lower than the cost of A. What about st? If st is higher, naturally the price of the option would be higher, because higher is the payoff st minus k. So, as far as the call is concerned, a call gives the right to the holder to buy the asset at the exercise price. Clearly, lower the exercise price, higher is the value of the call, more is the worth of the call, higher is the premium. And conversely, as far as puts are concerned, when the premium is directly related to the exercise price, lower is the exercise price, lower is the price at which you can sell the asset, and therefore, lower is the value of the option. Profit diagram of a long put. Now, what is a long put? A long put gives you the right to sell the asset at the exercise price on the date of maturity of the option. We are so far, please note, we are considering only European options. So, let us look at the situation st is less than k. If st is less than k, what are we saying? We are saying that the market price is lower than the exercise price. So, because the market price is and what is the put option? The put option is the right to sell the asset. So, if you sell the asset in the market, you are going to get st. If you sell the asset under the put option contract, you are going to get k. And please note, by assumption st is less than k. So, obviously, you would rather exercise the option, sell it under the option contract instead of not exercising the option. In other words, if st is less than k, the option would be exercised, and if st is greater than k, you would rather sell it in the market because the market price is higher, than invoke the option and sell it at the exercise price. So, not exercised. And what is the net payoff if it is exercised? Well, you buy the asset at st in the market and sell it at k in the market if st is less than k. If st is smaller, buy it in the market, buy the asset in the market and sell it under the higher price under your holding of the put option, under your long position in the put option at k. So, you pocket a profit of what? You pocket a payoff of k minus st. So, what do we have? The profit of a long put is k minus st minus the cost of acquiring of the option premium, which we write as minus p. So, the profit that arises if st is less than k is because buying the asset in the market at st, selling it at the higher price of k, getting a payoff of k minus st less the price you paid for acquiring the option. So, the net profit is K minus ST minus P, and obviously, if ST is greater than K, you sell the asset in the market, you do not exercise the option, and because you do not exercise the option, you lose the price that you paid for the option, you lose the premium that you paid for the option. So, the profit is minus P, and you can see from the diagram the maximum profit is curtailed at what? Maximum profit is equal to K minus P, the maximum, and what about the maximum loss? The maximum loss is equal to minus P, and the break even point is equal to K minus P. This is the break even point. So, this is K minus P, this is the maximum profit, this is equal to K minus P, and the maximum loss is equal to minus P. And this is the corresponding diagram for a short put. I will not devote time to it, it is pretty much the same way as we had for a short call. Now, we consider a very important relationship which is called put call parity. Let us look at a situation. Put call parity, let me give you the backdrop first. Put call parity aims to arrive at an equivalence between certain quantities, arrive at a relationship of the prices of a call option and a put option on the same underlying, same maturity, same exercise price. If you have two options, one is a call option, one is a put option on the same underlying, same maturity, same exercise price, then is there any relationship between them? Let us explore that. For that purpose, we construct two portfolios, portfolio A and portfolio B. In portfolio A, what we do? We take a long position in the call option. Because we take a long position in the call option, the cash outflow at t equal to 0 is equal to minus C, and the payoffs are going to be, if ST is less than K, the payoff is going to be 0, and if ST is greater than K, the payoff is going to be ST minus K. We also invest a certain amount of money. How much do we invest? We invest K e to the power minus RT, and on maturity you can see here, on maturity of the option we will get K as a cash inflow irrespective. Now, this cash inflow K arising out of the investment of the money at t equal to 0 equal to the present value of K is independent of the state of nature. In other words, you will receive this K irrespective of what value ST takes, irrespective of whether ST takes the value less than K or ST takes the value greater than K. So, the net payoff of this combination, a long call and an investment equal to the present value of exercise price is equal to K if ST is less than K, and is equal to ST if ST is greater than K. Let us look at the portfolio B. The portfolio A total I have written up here just to make comparison easy. For portfolio B, we buy 1 unit of the stock that costs you S0 at t equal to 0, because you buy the stock, it is a cash outflow. So, it is shown with the minus sign here. So, you buy 1 unit of the stock at t equal to 0, and the value of the stock at maturity will be ST, and this ST will be independent of whether ST is less than K or greater than K. It will throughout be worth ST, notwithstanding that what ST turns out to be less than K or greater than K. We also buy a put option, therefore, we pay a price for that, and the payoff from a long put is given by K minus ST if ST is less than K and 0 otherwise. And you find here that the net payoff at maturity it turns out to be K if ST is less than K and ST if ST is greater than K. Now, clearly the payoffs from portfolio A and portfolio B are identical in each state that ST can occur. If ST is less than K, both of these portfolios A and B give you a payoff of K. If ST is greater than K, both of these portfolios give you a payoff of ST. So, the payoffs are absolutely identical. There is no intermediate cash flow between t equal to 0 and t equal to capital T, and these payoffs are certain. And that means what? That means that the prices of these portfolios must necessarily be the same by the law of one price. That gives us this relationship which is called put call parity. Now, from where this factor of investment comes into play, I shall explain in the next lecture. Thank you.